Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be taking a look at NVR, stock ticker NVR. This one came in by request down in the comment section of one of my other videos. It looks like it's closed at exactly $9,000 a share yesterday, which is interesting. One time my car broke, like completely toast at exactly 150,000 miles. So it just reminded me of that. You hit those numbers exactly every now and then. All right, as usual, this is not individual investing advice. This is just how I analyze stocks. So NVR is a home builder stock. We can see on the fast graph here. So the first thing that I always like to check is the historical earnings cyclicality. And that's this kind of orange line or the dark green shaded area here. And what I like to really do is see how they performed during recessions. And if we go back, see if I can shrink this a little bit. If we go back to the Great Recession, there we go, we can see that earnings fell, let's see, from 88 down to less than 20. So that's like 80% or something off their highs. Now, obviously, this was a real estate centered recession, so that might not be too much of a surprise. But what it means is performing a traditional earnings analysis probably isn't a good idea because we never know when these earnings are going to really fall a lot, very sharply, just like they did during the last kind of real recession we had. And we can also see that we're coming off of what might be considered like a super cycle almost, or a boom from the pandemic, where we have earnings going up 230, more than double in 2 years, right? So that's a boom. They did have a pullback last year off the boom. So that kind of, we'll call it a bust off of a boom or a, recalibration or whatever. That did happen to some degree, and then growth kind of picked up again this year, it looks like. So, but we haven't had like an actual recession where earnings like really fall like off a cliff and like they did back in 2008. But when that happens, it really can throw off an earnings-based analysis. So if you went back to 2006, let's see, let's just pick, I don't know, we'll go right here. Looks super cheap, right? I didn't pick the very peak. The peak was back there. Earnings, the PE ratio was about 9. Earnings still did not, well, I guess they fell slightly that year, but they were pretty much flat that year. And then, but when you go from there down to the trough of when you take the stock price down to the trough of the recession, you still would have lost 60% of your money, even buying at a very cheap, quote unquote, PE of 9. Okay. So that's why these earnings don't really tell you anything or the kind of traditional valuation metrics don't really tell you anything when earnings can drop 80% in 2 years. So a PE, because down at the bottom, the PE was actually 16. It was double what the PE was near the peak, right? So it's exactly the opposite message that you should be getting. So you wanted to buy actually when the PE was double what it was back then. Well, that's just because earnings fell so much. So earnings analysis isn't very good for these deeply cyclical businesses. So what do? Well, then I revert to historical stock price patterns, and when we do that, might take a minute for my spreadsheet to pop up here, but so what I like to do is go and look at how big were the drawdowns off of the cyclical peaks, and that can give me an idea, once I control for a few things, if I want to buy this stock cheap, how cheap it might get in the future if it does a similar thing. So NVR here in my spreadsheet. So this is going to be a different method than you see me used with quite a few stocks. But I mean, I've done some cyclical ones on the channel before too. I think I put out a buy video for Norwegian Cruise Lines or Southwest Airlines, or a couple, right, deep cyclicals that I use this method for. So what I have here, once I scroll over to the right metrics, okay, so here are some of the drawdowns that I just glanced at. They didn't have a very big drawdown, it looks like, in 2001. These aren't super precise drawdown numbers here, because I just kind of glanced at these to put them in to give me like a quick reference on some of these. before I actually go buy them, I look more closely and do a little bit more thinking than what I'm showing you here. But the stock fell about we'll call it 65% in 2008, which was the last recession. In 2020, that drawdown was a little over 45%. Now, what's interesting about this, so my current buy price, I'm assuming it's like 65% off the high if we have some kind of like recession or something like that. So just in case anybody listening is wondering what that is, it's $3,487.40 is my buy price. That's 61% lower than where it trades today. So if you can't see it, you got it. That's the basic message. But let's get back to kind of some of the other interesting things about this. So what I thought was interesting when I was reviewing this one, because I've never really looked like super, even though I track it, I haven't looked super close at it because it hasn't been close to a buy price for a long time. So during these mid-cycle, I call them like mid-cycle declines, or kind of declines that can happen without having a recession. Usually, if you wanted to, you could buy the stock like 35% off its highs. So we'll go back to 2018 when interest rates were rising. You can see it fell about 40% off its high there, and just in less than a year. And then in 2020, during the March crash, I'm going to try to get this on the fast graph here. It's about a little over 40%. I think in the spreadsheet it said 46% off its high, right? And then in 2022, I don't know what this one's going to be, but it looked kind of similar. Almost, in between 35 and 40%. Probably peak to trough. Like if I tippy topped the peak and trough, it'd probably be about 40% decline. So all these declines that we'll call them like 40%, 40 to 45%. None of them, well, I guess technically the March crash of 2020 had a recession there, but they aren't like real recessions. We had a ton of stimulus and it was all pandemic related, and then we got this giant rise in housing, right? So that's very unusual. But that's just since the beginning of 2018, the stock has drawn down like 40% or more 3 times. So I would call those like mid-cycle drawdowns, and we'll call it like a 40%, 35 to 40% drawdown. If you're trying to buy it, and usually I don't try to like get the exact bottom. So if you saw in my spreadsheet, it was like minus 35% off the high. That would be, if you were going to try to buy this during one of those mid-cycle drawdowns, that would be kind of what you would be looking for. Then during the recession drawdown back in 2008, we'd be looking for more like a 65% drawdown. Now, because we had this kind of big boom here in 2021 and 2022, that makes me a little more cautious and makes me lean more toward a 65% drawdown. I mean, at this point, what did I say it was? Like 30 something, 3,400? Like that is, we might have hit that in 2022, almost. Yeah, we were at like 3,600. So that's not really going back to when times were like really rough, right? The 2020 low was like 2,400, right? That's a lot lower than where the stock trades now. So it a lot lower than like 65% off the current high. So I think it could drop 65% pretty easily in a mild recession or something like that, or anything that was like really real estate housing focused. That said, I follow a lot of these housing stocks, and the typical pattern is actually a mild recession or mid-cycle kind of drawdown type of a thing is usually a 50% drop for a home builder. And 2008 style decline or a real recession, you can go back for some of these stocks all the way to the 90s and look. 90s had a pretty rough real estate period in the early 90s. Typically, these home building stocks fall 80% or even sometimes 90%, but 80% is typically my threshold for recessions. So these guys are actually way better than the typical home builder, even the typical good home builder stock that you're going to try to buy. At least the past 20 years they have been. So only having a 65% drawdown for a home builder during a really horrible recession is really good. So it's definitely a high quality company I would like to own. I did a little bit of research. I was curious maybe as why. And what I read was they don't develop their own kind of land. They buy the lots from developers. So they take some of that risk off the table, and then it looked like they have a mortgage business. My guess is as soon as they originate these mortgages, they sell them. So that they're not probably holding. I didn't go look specifically, but I'm almost sure that they probably sell them after they make them to the people who are buying their homes, right? So that risk is kind of, taken off. They're not like holding these long-term like mortgages, is my guess. You could double check it if you really get into it. But when they do those two things, well, they take a lot of the cyclicality, I think, out of their business, or not, or a lot of the more of the risk, right? So I think that's my hypothesis as to why they're a little bit better than the average home building stock. So yeah, you kind of focus on that. I mean, let's see what 35% off of. I think 9,600 or something like that was the 0.65, like $6,240. That would be a roughly 35% off the high. So if you were feeling like you really liked the business and you wanted to make sure you got a piece of it, that kind of getting close to 6,000 would be where you might want to start taking a position, just knowing that it could definitely fall a lot more than that if things get bad. So that would be my approach for the stock. But yeah, definitely a good one. Definitely one to keep an eye on. If anyone's interested, I have a weekly picks service now on Patreon, which is $25 a month. It started in October, doing really well. Also, anybody that joins any of the paid Patreon tiers gets a big discount if they ever decide to join the full Cyclical Investors Club service on Seeking Alpha, which is where I actually spend most of my time. And those links will be down in the description. I also have a 25% off affiliate link for Fast Graphs, which you see me use in all these videos. If you ever want to try it out, they have free trials. As you could see when I was looking at NVR and I go back and look at their earnings history, I can identify whether they have a cyclical business by looking at these earnings really quickly using Fast Graphs. So I immediately kind of know what I'm dealing with. Sometimes I look at it of a random stock and the earnings history is horrible, and so I just know it's not for me and I move on, and it only takes like 5 seconds of my time. So I find it's a big time saver, especially when sifting through stocks that you haven't looked at before. So if you want to check that out, there's a link down there for that too. Thanks for watching. If you enjoyed the video, give it a like, leave me a comment. You have a request, let me know. I'll put the ticker on the whiteboard. I'll make a video for you. If it's a stock that's in the S&P 500, I post those on YouTube for free. The rest I post on Patreon. All right. Thanks for watching, everybody. See you later.